All right, for this section, we're going to talk about venture capital. We're going to answer questions like what is venture capital? Who are VCs or venture capitalists? Who are LPs or limited partners? And what do you need to know about venture capital as a startup or early stage company? So, what is venture capital? Well, venture capital supports new ideas that could not be financed by bank financing, threaten established products and services, and typically require 5 to 8 years to mature. That's the definition provided by the National Venture Capital Association. So let's think about this in the context of the two companies that we've always been looking at and trying to evaluate within the context of our business. So we had UWash, which is a local laundromat to fix the problem of not having time to do laundry. This, again, with all the tangible assets, the physical locations, the very local style of the business, this is probably appropriate for traditional financing, right? Traditional bank financing and other ways like that, lines of credit and things like that sort of financing. Whereas WeWash, there's no physical location, there's not really any tangible assets, maybe some computers. It's mostly intangible assets, and it's going to take a long time to be cash flow positive. However, this company can scale. It can threaten other established businesses. It can threaten the entire laundry business in particular, and it can grow on a worldwide basis. So this is what we're talking about when we're talking about companies that are ripe for venture funding. So let's go back to that. Could not be financed by bank financing. That sounds like WeWash. Threatens established products and services. That sounds like WeWash. Typically requires 5 to 8 years to mature, to have profitability. That sounds like WeWash. So who are VCs? Who are venture capitalists? We're going to look at this one definition provided by the National Venture Capital Association and break it down into its component parts. Venture capital firms are professional institutional managers of risk capital that enable and support the most innovative and promising companies. Let's look at that first part, professional managers of institutional managers. So venture capitalists are professional institutional managers. They're broken up into two different players, and they're formed under a vehicle called the limited partnership. When we talked about choice of entity, we said that we'd mention limited partnerships in a very specific way, and this is that specific way. When we're talking about venture capital funds or other type of private equity funds, these are usually organized as limited partnerships. In a limited partnership, there are two key players. There's the general partner, or more commonly known as the VC, which makes all the management and investment decisions, and the LPs, the limited partners. These are the investors of the VC fund. They invest their money into the fund itself, and the GP takes that money and invests further into startup companies. Let's go back to limited partners. There are two aspects of being limited. Limited liability, which we've covered. Those LPs are only limited in their liability of the amount of money that they have contributed to the fund, the amount that they invested in the VC fund. And limited governance. They're only going to have a limited amount of say in what the VC does and how they invest in that money. Usually they do this by carving out some restrictions on the investment, the nature of the investment, reserving certain capital to be saved for follow-on investments versus initial investments and things of that sort. The general partner, in contrast, has unlimited liability, and then in that same respect, they get much more of the control and management rights. So the thing to note about LPs or limited partners is LPs are the lifeblood of venture capital. Without LPs, you wouldn't have entrepreneurs. Why? Because LPs invest money in the VCs who invest money in the entrepreneurs. So it's important to think about venture capital in the context of the incentives of the LPs. Why? Because that, in turn, incentivizes the VCs, which in turn incentivizes the entrepreneurs. So who are LPs? Well, LPs are usually wealthy individuals or institutions, such as private foundations, university endowments, family offices, or just wealthy individuals. These LPs, they need to fund their operations, right? A private foundation, a university endowment, a family office, they need to be able to use the profit that they make from investment to carry on their business and to operate. So one way of doing that is by making diversified investments. They're going to make investments in a large quantity and an assortment of different vehicles, right? So they might invest in bonds, they might invest in public stocks, but they're also going to want to invest in venture capital investments, right? And what they're looking for when they're making investments into venture capital investments are outsized returns. Outsized returns are basically just means that they're returns that are disproportionate to the amount invested and compared to other investment vehicles like bonds. So LPs use these returns to fund their business, and they also need liquidity. So generally, what you'll see in a limited partnership agreement, which is the agreement that sets forth the kind of the terms and conditions of the venture capital fund, is that a venture capital fund's life is usually between 10 to 12 years, but they tend to limit the scope and the time horizon that the initial investments can be made, generally between about 5 years. They reserve some of the other investments within for follow-on investment amounts. Let's go back to that definition again, now that we've seen kind of the first aspect about the professional institutional managers. Venture capital firms are professional institutional managers of risk capital. So let's talk about risk capital again. Remember when we looked at UWash and WeWash? Risk capital. UWash, they have, some assets, they have some short-term cash flow, so they're not as risky, but there's not that high reward. Right? So let's look at WeWash. WeWash has a huge potential customer base worldwide and long-term cash flow positions. So let's look back again at that definition of the National Venture Capital's definition of who are VCs. We're talking about investing risk capital that enable and support innovative and promising companies. We've talked about this a little bit before, the difference between debt versus equity, and we're going to look at this in the context of risk capital. The nature of the security, debt versus equity. We're talking about debt. A lender lends money in return for interest and repayment of the principal, the amount that they lent. That return is going to be fixed, and it's also probably going to be secure. So it incentivizes the lender to make safe bets. They're not going to bet in the upside or a company's potential for upside. They're going to make safe bets in which they know they can return the money that they loaned out as well as the interest. When we're talking about risk capital, we're talking about equity investments. They get all the upside and the appreciation of the business and its assets that are in excess of its liabilities, the amount of profit it has, right? The amount that's after they pay off all of its debts. Again, equity doesn't secure any assets in particular. There's no repayment schedule really, but it's got unlimited upside. So that's the bet that investors are making and VC investors are making when they're talking about risk capital. Also, let's take a look at the types of companies that we're talking about when we're making risk capital bets. So these are venture capital firms or professional institutional managers of risk capital that enable and support the most innovative and promising companies. Innovative and promising. Back to WeWash. WeWash, they have no physical location, but they have intangible assets. They have long-term cash flow. They can grow and they can reshape the laundry industry. They can take that on a worldwide scale. So that's exactly the type of company that we're looking at. Why? Because venture capitalists are looking for home runs. And they're looking for home runs because that is what their LPs are looking for when they invest. They're making diversified investments. And one approach that they're looking for when they're making venture capital investments is that those venture capital investments can have outsized returns. So this in turn changes or influences the dynamic of the venture capital fund or the general partner. They're going to want and they're going to expect that, between 30 to 50% of their investments might not work out. Maybe 20 to 30 of their investments are maybe break even or small upside, but they're really counting on the 20 to 30% of their investments to 10x to provide some type of disproportionate return on the investment. And so VCs are going to be evaluated by LPs based on the size of their winners, the home runs that they hit. How often did they hit those home runs and how big were those home runs? And this is all built within the structure of venture capital, right? So it's important to kind of think back to what we were just talking about right there and think about how the GP in turn makes money and how it returns capital to its investors as well. So basically, the GP receives something called a carried interest, and we're not going to go into this in too much detail right here, but basically, once the general partner returns all of the capital contributions, the money that were invested by the LPs back to those LPs, then they are going to get a 20% return on all profits, is usually the way that a carried interest works. So those VCs are going to be incentivized to get to those winners quickly and efficiently. They're going to want to do that early on in the process, so that way those profits in excess of the money that's returned to the LPs, they're going to get that 20%. So that means that the winners must represent a large market, which often requires disrupting an entire product, service, or industry, which is exactly what we saw, what we see when we look at WeWash compared to UWash. So why do entrepreneurs need to know anything about venture capital? Why do we need to go through the whole detail between limited partners and general partners and that whole spiel? Well, one, they need to identify if venture capital is appropriate, right? It's not appropriate for UWash. It's just not within the model. There's no way that a venture capital firm would be interested in making that investment. But it is for WeWash. It's also important to understand the expectations that a venture capitalist is going to have on making their investment. It's also important to ask the right questions. So, for instance, when you're approaching a venture capital firm or a GP and you're interested in trying to figure out if that makes sense, there's questions that you need to ask, maybe even to the VC directly or just in your research, such as, does the VC invest in my particular industry? For instance, is this VC just in biotechnology? Are they just in deep tech? Are they just in a particular industry that I'm not in? If that's the case, you're not going to want to waste your time there. They're not going to be interested in making those investments. Why? Because their LPs might use a little bit of their governance rights to limit the type of investments that they make. Does the VC invest at this particular stage? There's other sections of the videos that we're going to discuss the stages of financing, but you need to be able to understand whether or not the VC invests in the stage that your business is currently in. Also, what stage is the contemplated fund in? Is the fund just getting started, or are they at year 4? If they're at year 4, there's going to be some different expectations for you there, because as we talked about, the VC fund might have restrictions on when they can make initial investments. So if they're in year 4, those VCs are going to be looking to return their capital to the LPs pretty quick. So there might be some expectations and some incentives for them to push you to sale a little bit sooner than expected, or a little bit more pressure to have a return. What percentage of the fund is allocated to follow-on investments, right? So is this investor just going to be giving you one check, or can you expect that they will also be able to finance your next round or invest in you in the future? What size investments does this VC like to make? How much is the check size? It's a way of asking that. How much is their ordinary check size? And in return for that check, what percentage of the company do they expect to own? This will help influence your decision-making process, make sure that you get right in front of the right VCs, and have a better understanding of what the expectations will be. So we hope this was helpful in kind of understanding the general dynamics between venture capital. And until next time, venture awaits.